Are we in the middle of an equity melt-up in the U.S. markets? The S&P 500 has been hitting all-time high after all-time high. NVIDIA just broke through the $5 trillion mark. Microsoft is hot on its heels as well, over $4 trillion in market cap, and we're looking at seasonality here today as well. I've invited a fantastic guest to sort of help us understand what is happening in the markets, what is momentum like. He's a technical strategist. His name is Mark Newton. Really looking forward to catching up with him, and really hope he can make sense for it. He can make sense of it all for us, because there are a lot of macro news hitting us this week as we speak, or in about 5 hours time as we're recording this. The Fed will release its announcement on a potential cut, 99.9%, so we can assume that's a 25 basis point cut. But we also have the APEC meeting. We have earnings hitting us as well this week, so lots going on, and I'm really looking forward to that conversation. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and we much appreciate it. Thanks so much for doing that. Now, Mark, it is a great pleasure to have you on the program. Thanks so much for joining us.
Thank you, Kai. Nice to be here.
Mark, it's your first time on the program. Let's see where your head is at right now a little bit. Maybe give us your assessment of the economy and the financial markets from your standpoint.
Well, honestly, the markets have, to your point, have escalated pretty dramatically higher. A lot of that has been led by technology in recent months. If you look at the market, in general, many of the sectors have not really participated. So we're in an interesting time in the economy and in the markets where other sectors are starting to diverge and are not really participating as much as what tech is. Of course, we have the earnings 5 of the Mag 7 this week. So NVIDIA today crossing $210 is going to hit its $5 trillion mark. Remarkable. And yes, that does represent, 8% of the market. So, the markets have been on a tear. We're up 17% now on the S&P, and the last 2 years we've been up over 20%. Many, I think, would have argued coming into this year that markets might experience some turbulence or be flat, but as we know, earnings have been in very good shape, and the economy, I think, has held up much better than anticipated. So, despite some evidence of weakness on the fringe with regards to the labor market, the overall economy and earnings have held up, and it really continues to be important to pay attention to those, versus trying to use geopolitics or even the political arena to try to make decisions regarding risk assets.
Yeah, no, it's a definitely interesting time when it comes to that. Earnings in good shape, and it's quite bifurcated. What sectors are leading right now? You touched on tech. Interesting statistic: 398 of the 500 companies in the S&P 500 were negative yesterday, despite a positive, a green day in the S&P 500 yesterday. What do you make of that? What should we be focusing on?
Well, it is important, and it can be a negative if it persists. So you definitely want to see all sectors starting to rise in unison. And when it's only led by tech, yesterday was one of the worst breadth days we've seen in years. Today does not look to be any different. We have NVIDIA, of course, leading the charge, but yet market breadth is down. The majority of sectors are not higher, they're lower. And just over the last month, we've seen actually 5 sectors out of the 11 have been negative over the last month, which is remarkable when you think that the market has just been continuing to push higher. So, look, at some point, it is important to start to see groups like financials really lead the charge. To your earlier question, it's really been technology and almost exclusively over the last 3 months, but we have seen utilities and healthcare, and to some extent, other areas, have tried to make some headway, but really in the last month, it's been, financials, real estate, communications services, and energy have all been down, and so, industrials have been largely flat. It is necessary, for those of us that study market structure, you look at Dow theory, you want to see, the transportation index along with the Dow Jones Industrial Average, as well as the equal-weighted S&P and the S&P and the NASDAQ all moving higher. And right now, there's begun to be a little bit of a divergence. That's not problematic until tech really starts to stall out and roll over, and that hasn't happened yet. So, yes, tech does have the power to carry this market at a time when other sectors aren't participating. The key is the sentiment, and the sentiment right now is still largely mixed. We don't have a lot of speculation for a lot of understandable reasons, but until that changes, the market can go up really with no rhyme or reason, and does not have to simply fall because investors are bearish about tariffs or course of action for the Fed or inflation or anything else.
No, I appreciate that, Mark. Before, maybe to set up my next question, like you're a technical strategist. I think we need to explain that term just a little bit. What do you actually do, Mark?
Well, look, I mean, technical analysis is a study of price action. So I look at, volume, charts to make decisions, looking at seasonality, sentiment, market breadth, momentum. I always try to identify, stocks that are breaking out to new all-time high territory. Momentum has been the number one factor over the last 20 years. So here at Fundstrat, I write an investment report every day and I do videos. And so I cover technical analysis. I basically guide investors, retail as well as institutional, to try to understand, what sectors are starting to improve and really what the best stocks are that they might be concentrating on. But I also have a little bit of a macro bent. I do look at interest rates. I look at the dollar. I look at cryptocurrencies and metals. And, there has been some correlation, of course, across some of these groups. And so, very important to understand all of it, but really looking at what's moving and what has the potential to move versus taking, a fundamental or, listening to the Fed, talk about what they expect. It's very difficult to make money. Many times, price is already baked in, a lot of what's being said. And so, technicals allow you to sort of take the blindfold off and see, price action of things that it can start to lead. And we always hope that in the long run, it mirrors fundamentals, but sometimes there's that divergence, and really that's where I step in.
No, Mark, maybe a bit of a cheeky question. You have Bloomberg running behind you on the TV, and that is a lot of noise, of course. Mainstream media, building their own narrative around what is going on. How do you manage to sort of blend that out and not maybe pay attention to what Jonathan Farrow and Lisa Abramo would say in the morning?
Well, I appreciate their insights. Sometimes, having another set of eyes on what's moving can help you to understand different things that are happening across the economy and across different markets. But I, first and foremost, looking at markets 24/7, I always want to just be on top of what trends are showing us for not only, U.S. stock indices, but across the dollar and interest rates and everything. And so you basically go from there, and you really want to just concentrate on what sectors are leading or starting to lag, and look at market breadth and momentum. And I think it still remains an underutilized talent. Many American-based portfolio managers have always been taught the prudent man rule. You manage money based on having a duty to your constituents, to manage based on fundamental analysis and finding intrinsic value for the companies you're investing in. But having a technical screen is really more important than ever these days, and really either for risk management purposes or really for the purposes of adding alpha to your portfolio management process. And so I try my best to, obviously give my insight to all of our institutional and retail clients, and really talk about the day-to-day movement of what's happening and how people can use that to make money.
Fantastic. Yeah, no, you mentioned seasonality a couple times already in this conversation. It's the end of October, 2 months left. In terms of seasonality, where should we be at? We're in the middle of a melt-up right now, but how sustainable is that melt-up given maybe seasonal context here?
Yeah, it's a great question. Look, this post-election year has proven to be, I think, a little bit different than maybe most. It is showing very good performance, but the performance has far exceeded expectations. We did not see any real drawdown in August, September, or October, with just a few days left. And now I think a lot of people are using this resilience as a chance to get bullish and think it's going to be all, guns ahead, guns a-blazing, and just sort of pedal to the metal until year end. I think a lot of people, CTAs and just professional money managers, have not been as actively exposed to risk assets, and so this sort of need to play catch up is very real. I think the problem is when you start to see breadth start to tail off, like we have seen in the last few months, and fewer sectors participating. As technology gets stretched, you do set yourself up for the possibility of at least some consolidation in the indices, and so I see that likely happening from right near 6950 in the S&P, and we're very close to there now. That likely takes us down into probably the middle part of November into November expiration before we can continue to push higher. So, honestly, the best part of any given year in stocks is almost always to buy into dips in October and hold into the late spring. And so you have that typical October till late April window, which over the last 100 years has allowed investors to earn at least 3 times as much as if you invest really from May through October. But this year has proven to be far different. We had the early year decline on tariff worries, bottoming at the exact moment they were announced, of course, and then fear rose to levels we really haven't seen since the prior bear markets. And so that certainly is is very interesting. But to get back to your question, if you have in any normal year, you normally want to be investing money and buying dips into the fall period and looking to sell into the spring. Being out of the market, really momentum starts to turn down in the summertime because the fall period is usually quite treacherous. But this year is anything but normal, as we all know.
It isn't, that's for sure. But I think that the trend is clear, though. It seems quite positive, at least what I'm hearing or seeing out of the U.S. Europe is a whole different story. It seems to be a complete mess. That's where I'm based. I'm not very hopeful of what is going on. I'm just looking here at the CNN Fear and Greed Index. And what is really interesting is the market momentum versus the stock price strength. Market momentum, we're seeing extreme greed, a lot of money, a lot of momentum, as you said earlier. Yeah. But on the stock price strength, we're looking at fear. Meaning there's quite divergent. Maybe you can elaborate on that a little bit, because I think you touched on that already in your previous answer. But it is quite interesting because what they're mentioning is that a few stocks skew the returns for the rest, right? Meaning that's where the fear is coming from.
Well, I think, look, that's where the earnings are also. So we look at the Mag 7 and big cap technology. Those are the companies that are changing all our lives for the better, and it's important for those stocks to be making good money as well as helping to carry the market higher. This is no different than any decade going back over the last 100 years. I mean, back in the 1930s, 40s, we had, of course, the generals, General Electric, General Motors, Exxon, DuPont. Those were all really heavy weightings within, equity markets. And so that did not necessarily necessitate being called a bubble just because they were heavily weighted. And so every decade has its share of really what's leading and what's not. And most recently, of course, we have our Apple and NVIDIA and Microsoft and Alphabet. And so those certainly have been the ones that have been carrying us. To your earlier point, though, we only have about 50% of all stocks right now that are above their 50-day moving average. And so that is a little bit of a concern because, in the last few months, we have far fewer stocks pushing higher than normal. As to what you do with that information, that doesn't mean you run out and go to cash, but it does mean you have to keep a very careful eye on trends and really watch sentiment closely. And the cycles, in my view, are still very positive for this year. Even if we do have a little bit of a consolidation in November, I still expect to end the year on a positive note. But next year, heading into a midterm election year, to your point on seasonality, it can be a little bit different, and we might get some consolidation next year.
Yeah. What you've been saying is it reminded me a lot of 1999. And should we party like it's 1999? Do we have maybe two more years before a breakdown? Can you put some historical context around what is happening right now? Is it even comparable?
I would say it is not comparable. It's almost been fashionable to try to call everything we're seeing now a bubble, particularly those that have not participated in it, maybe to the extent they would have wanted. We're in a bubble about talking about bubbles, and that's the problem, I think, in this day and age. While PEs might seem overvalued, we're trying to put a value on an area of the market that really none of us have ever experienced before, and that we continue to hear the degree of AI spend being just through the roof and overwhelming demand, and most CEOs on every conference call continue to extol the virtues of just the fact that the businesses are growing faster than ever. And so I think that PEs in the high 20s, or if you consider parts of Mag 7 maybe in the low 30s, are certainly nowhere near what we saw in 1999 when we had the stocks like the Siebel Systems or Exodus Communications or so on and so forth. And some of these were trading at 150, 200, 300 PEs. And the use case in this society and utilization is far greater than what we've seen in some time. These companies are actually, minting money and are doing a lot of good for society and making all of us, I think, more productive by use of AI. So, there's a big deflationary impact from that, and as prices start to come down because the average consumer is getting much more productive, and that helps to offset, I think, those inflationary worries when you mention when people talk about tariffs or whatnot, and we have a plummeting price of crude oil and the AI effect on being deflationary. That puts us in a sweet spot where the Fed can afford to cut rates and not really have to worry, in my view.
Yeah, cutting rates in a positive economic environment. Like, how do you put that into the same sentence and make it make sense? Actually, like, you gave us a hint here, just now, but is that even the right move? If we were to talk about that,
I think it is the right move because I think that mortgage rates have grown. They basically doubled in the last few years for those in the U.S. Many people with homes had mortgages locked in at the 3% for some time. Know that now that's grown to 6.5%, 7%, and since COVID, many of the house prices have grown by over 50%. And so, honestly, that's an area of the market where I think we could be vulnerable over the next couple of years. As the housing market, they've simply become too unaffordable, and the cost for owning a mortgage on properties, although historically maybe lower on the lower end of things, is still quite a bit higher than what we've seen in recent days. So difficult for a young college grad coming out of school, and unemployment is higher for college grads now, to think that you're going to go out and buy a home with very high mortgages. So the act of cutting rates, although that is, that affects the short end of the curve, obviously, it does have the effect of, bringing down, the cost of borrowing, I think, which is going to be essential at a time when companies have largely stopped hiring as aggressively. So we're not really laying off people, but it's not as if the economy is going gangbusters. There are certain pockets that remain problematic. And I think if you can bring interest rates down at a time when inflation doesn't soar, then I think that is the right call.
One topic we've touched on a couple of times here on this program on Soar Financial is the subprime auto loans. And do lower interest rates help that sector as well? It's a $1.7 trillion sector that seems to be in crisis after that tricolor bankruptcy or insolvency here. Are you looking at that skeptically? Is that where a potential market breakdown could be coming from?
I'm not a credit specialist by trade, but I do look at a few measures for just looking at the option adjusted spread and looking at just the ratios between investment grade credit to junk, and when that starts to widen out dramatically, that can be an issue. There might be defaults or problems in some parts of the economy, but I don't see that being a systemic issue that really should metastasize, I guess, across the economy at this time. Credit does not seem to be in crisis mode. We have had a few of the regional banks, of course, with their own issues, but we just had 6 major banks come out and report earnings in the last 3 weeks, and none of them spoke about credit as being a really big issue for them. So I would have to say that there are many that wish to sort of fit their own narrative by looking at what's negative, and I understand that, but I don't think it's an issue right now for the broader economy just yet.
Perfect. What I'm trying to do here is fish maybe a little bit for some breakdown signals, things that you're looking at as well, Mark, that could show us a shift in momentum perhaps, and that market breadth, as you mentioned, is probably one of those breakdown indicators. Curious, like what else are you looking at?
Yeah, when I look at markets, say, for over the last 100 years, I mean, almost all markets peak out when you have just fewer and fewer stocks hitting new all-time high territory and start to decline. And we have seen a little bit of that since July, but it hasn't been as pronounced as what we saw in 2021, nor in the late 90s and 1999. We saw fewer and fewer stocks carrying the load, and stocks in general started to be lower. So bull markets don't peak when all stocks reach their high and pull back. It's largely just that process usually starts about 3 to 6 months ahead of a peak when fewer and fewer stocks hit new highs, and the market's just it's a bit thin or so at the top. So I don't sense that we're at that level yet to be really concerned, but I do suspect that if the market were not able to rally through year end and see really small caps participate after their recent breakout, or see financials snap back to life, or industrials, which are, these are a couple groups that have been lagging of late, that could be a problem heading into next year. So I also look at sentiment. Most of the bull market peaks that I've seen in the past, they all have very exuberant levels of sentiment where there's a lot of speculation, and we just haven't had that this year. To think that the market is just all of a sudden going to roll over and go into an extended downturn when everybody's negative, doesn't make a lot of sense. Normally, on the first sign of weakness, people tend to get very fearful, and that honestly puts in a floor from a contrarian perspective as to when you want to buy stocks. So the combination of sentiment and momentum and breadth are certainly important, but you have to look at market cycles, and we're in one right now that suggests that this year should be a phenomenal year. Next year, could allow for some consolidation, and we can speak about that in the future. But my indicators, as long as tech is moving up, are still quite bullish. But I do acknowledge that tech has gotten a bit over its skis in some of the parts of technology, data storage, the Seagates and the Western Digitals of the world, Micron, or you look at the semiconductor sector, and it's just gotten very, very overbought, and it's just unsustainable in my view, regardless of what the future that they're with the chips and the deals that might be done with China. So I think there is going to be some consolidation. That the key is for the rest of the market to sort of be able to hang in there and rise to the rescue and help out technology. And there's no guarantee that happens, but that's what I'm expecting probably eventually should happen in the months to come.
Yeah. One sector that could potentially help out with that is the mining sector. And to steal a phrase you used, is that sector is currently minting money at current levels. Free cash flow and free cash flow yields are through the roof. Newmont just reported last Thursday $1.6 billion in free cash flow just in Q3. What is your sort of take on, maybe we'll start with the commodities first here on gold and silver in the precious metal space before we talk the mining stocks themselves?
Yeah, I've been on record as of last January in my annual report of thinking that gold would go to really 4,800 and then start to peak out. And a lot of my cycles show that October is a pivotal month where the metals start to turn down. So interestingly enough, at a time when everybody has just recognized the fact that the metals are moving, and for good reason, when you look at lack of Fed independence potentially, or fiscal concerns, and really no political party really wants to address cutting entitlements on either side. Real rates have been moving down. Those are all very bullish fundamental reasons for why the metals should be able to work. But when you see a shot across the bow like we've seen lately, despite the central bank buying, it's a little bit of a warning sign for those that are true trend following investors. And I think that that's a little bit of a wake up call. So I'm not as optimistic. I've encourage investors to trim their holdings, and I think we probably have a little bit more to go on the downside. It's going to become more of a trading environment, I think, more than a place to invest long term, given that gold has been rising now for over 3 years, and silver has honestly had a much better year than gold. So a lot of it's going to depend. My honest view on both the miners and also on gold and silver is that we probably have one more leg down into mid-November. We probably try to rally into year end. And then 2026 is going to be down. And the reason for that, I think, is because rates have gotten artificially probably a little too low on the long end. I think the Fed's focus now is back towards growth. Most of the rate cuts have been factored in. They anticipate that the U.S. will be able to snap back and show better than average growth. And that can cause a steepening in the yield curve. And if rates start to rise, historically, that's not been a great environment for the metals. So I'm a little mixed at this time. I'm not as wildly optimistic anymore on the metals. And I think that they become more of a trader's environment for now, more than one you want to just buy and hold after 3 years.
No, appreciate that. It's really, really insightful. Maybe on the opposite end, then, like, are you bullish than the U.S. dollar, for example?
I do think eventually the dollar will start to rise. I don't, I expected a little bit of a bounce into early next year, and then I thought we would have a final flush into next year, which should be very supportive of, potential commodities as well as emerging markets. We've already seen those snap back to life. But the long term, I think you have to favor the U.S. as being likely in a better spot than Europe, and I think that. Um, eventually that's gonna translate into the dollar starting to head back higher. So it's a tricky time because the dollar has already had such pronounced weakness here, and now we're starting to sort of churn sideways, and we've seen that with both treasury yields and also the dollar. And I think it's going to be, ideally we get one more big move down, which happens into probably next spring, and then it's probably time to consider going the other way, honestly. I think yields are going to start to rise, and I think the dollar probably also starts to move up.
Maybe to summarize our conversation a little bit, Mark, but maybe to wrap it up here as well, like what should investors be paying attention to until year end? 2 months to go here. And any themes that we should be paying explicit attention to?
It's less about the themes; those have really been, a constant focus on AI. It's more just about, keeping an eye on the longer term trends, keeping an eye on sentiment. Um, really paying attention to the sector rotation, and hopefully we can see more sectors starting to come to the rescue. I think it's just really, really valuable to pay attention to these longer term trends and how they can really help investors to stay invested at a time of just, a lot of volatility and a lot of exogenous events and things that are happening all around the world that people think probably should cause damage in the U.S. stock market that just really haven't. And so, that's no different than any other year. We had worries about COVID, or every year brings its share of issues. And with the speed of information flow these days, most networks broadcast that loud and center to investors. It's just created a little bit of a wall of worry and a little bit of a negative climate with regards to how we all think about the economy and the market. And honestly, things are still, I think, in much better shape. I do believe we're in a secular AI boom that likely lasts for many years, but I don't think it's going to be straight up. I think there'll be pockets of where markets can weaken. But the key is just never. If I had to give one piece of advice to investors, I would say just beware of trying to buy big pullbacks. It's always been my experience. It is very, very difficult to try to buy dips. I know it's human nature to buy low, sell high, but in reality, we should all be taking a little bit more of a momentum-driven focus and buying high, selling higher. When they start to weaken, we just get out of the way and not be in a rush to buy dips, because that truly can be a portfolio killer when you're involved in something that just is struggling and you have a value that you think it should be trading at and it doesn't, and you can't understand why. And honestly, the technical tools can really allow you to put a finger on that and really to hold off on being too aggressive until the technicals and the fundamentals both line up and they're both starting to move higher. And so that's with AI tools or with other screening tools, it's very easy to implement something like that in today's society. And I think investors would be, should be paying attention to ways that they can use all the tools around them to help them these days.
Fantastic. No, really, really insightful there, Mark. How can we follow more of your work? Where can we send our investors?
So if you go to fundstrat.com, that's simply an area where you can learn a little bit more about our firm. So myself, along with Tom Lee, and we have a crypto team as well as a policy guy, and it's a wonderful firm. fsinsight.com is really our retail-based area where you can come to see. You can subscribe to research at different levels depending on if you're an investor or if you're an RIA. We have different levels are broken down, or if you're an institution, we can work more with you one-on-one. I myself am on X at Mark Newton CMT, and I would just encourage you to stop by and happy to give your viewers a trial if they'd like to sort of see what it's all about. So I'll send you the links on that. You can pass it out, and if people have an interest, then stop by. And Tom's data, of course, is longer term, intermediate term. He's looking at top-down inflation and economic data, and I'm more tactical day by day and just covering what's moving and why. And so oftentimes we complement each other very nicely. And so I think people have been very happy with our success.
Fantastic. Awesome. Mark, really appreciate your time. Thanks so much for coming on. We'll have to do this again soon. When do you publish your annual outlook?
That will be sometime in the middle part of December. I'm going to Tokyo and I have to present there first. And so I might make a couple changes, but not many. So it'll be sometime in December. And before I forget, we have started an ETF. The ticker symbol is Granny, GRNY. So for those that remember Rick Barry's granny shot in the NBA that led Will Chamberlain to score 100 points in the U.S. game of basketball, that was instrumental. And the thinking being that it's so easy to shoot a granny. And so these companies that we invest in on the large cap growth side, they hit a number of different metrics. And so it allows them to be, hopefully have a higher probability of success. And so it's been a phenomenal success after 11 months, and we're up to over 3.5 billion without being on many platforms. So
didn't they change the rules for free throws though afterwards?
I don't know if the rules were changed. I don't know that many people use that anymore. But those that have tried it, I mean, I like the old-fashioned way, but then again, I'm no basketball player. So
yeah. Now I was watching something. Michael Jordan took his first ever free shot in like 10 years because he hasn't touched a basketball in like 10 years, and he was super nervous. But he was explaining about something about Will Chamberlain, his free throw shots, because he used to run into the free throw, right? So that's what that reminded me of. That's why. Yeah. No, Mark, really appreciate it. Thank you so much for joining us. We'll have to do this again soon, maybe right after you put out your annual report. Be great to get your take on things and where you see things headed in 2026. So much appreciated, Mark, and everybody else. Thank you so much for tuning in. Really, really interesting week as we're speaking here today on, Wednesday, October 29th. Lots of macro data hitting us, Fed decision looming here in a few short hours, but also the APEC meeting. Lots of momentum in the market, especially in the S&P 500, but the miners are catching a bit here again as well. So I'm really curious what you think of Mark's take. Please put that down below, and if you haven't done so, hit that like button as well. So thank you so much for tuning in. Take care.